Mark, yeah, it seems like you get a lot of growth managers that just keep writing things up and then they tend to write it down. Maybe touch a bit on your valuation and sales process.
Well, so I think the important thing is, not to drink too much of the Kool-Aid, and when things get overvalued, not being afraid to take some money off the table is important. And at different points in different economic cycles, certain parts of the market become overvalued, and companies become overvalued that are a part of that and part of those industries. I think tech is up close to 30% this year, and the market is flat. And, it's one of those times when, there's a high level of disparity between the two. If anything, we've been a little too cautious this year. And so, if we'd held on to some of these companies a little bit longer, we probably would have done better. But, having done this for a while, sometimes being a little cautious is not a bad thing. And so if you can be willing to, take a step back when everybody gets excited about something, that can really help you over the long term, because it means you're not going to get crushed in a bear market. And typically that's what we try to do. We sell things when we think the valuation no longer reflects the underlying fundamentals. And so what we do is we make an estimate of what the growth rate of the company is when we invest in the company. And if the company sells for more than 2 times the growth rate, then that's a sell trigger. Sometimes the growth rate accelerates. Sometimes growth rates decelerate, which is always a bad thing if you own a company with a high valuation. But generally, that's how we look at it. And if we'd much rather invest in companies with stable or rising growth rates than falling growth rates. And hopefully we invest in these companies early on in the process as opposed to late in the process.